The previous video established why investing matters and the foundational conditions under which it makes sense to begin. This video goes inside the investment universe itself and covers the major asset classes, what each one is, how each one generates returns, what the risk profile of each looks like, and why holding a combination of them rather than concentrating everything in one category is the approach that produces the most reliable long-term outcomes for most investors. An asset class is a category of investment that shares similar characteristics in terms of how it generates returns, how it behaves in different economic conditions, and what risks are associated with holding it. The major asset classes are stocks, bonds, real estate, and cash equivalents. Each occupies a distinct position in the risk and return spectrum, and each responds differently to economic conditions like interest rate changes, inflation, and economic growth or contraction. Understanding these differences is the foundation of portfolio construction. Stocks, also called equities, represent ownership stakes in companies. When you buy a share of stock in a company, you become a partial owner of that business, entitled to a proportional claim on its assets and earnings. Stocks generate returns in two ways. The first is price appreciation, meaning the stock's market value increases over time as the company grows and becomes more profitable. The second is dividends, which are periodic cash payments some companies make to shareholders out of their earnings. Not all companies pay dividends. Growth-oriented companies often reinvest all earnings back into the business rather than distributing them to shareholders, so price appreciation is the primary return driver for those holdings. The historical long-term return of the broad United States stock market, as measured by indices like the S&P 500, has been approximately 9 to 10% per year on average before inflation and roughly 6 to 7% after inflation. The return has not come smoothly or predictably. It has been punctuated by significant downturns, including declines of 30, 40, and 50% or more during periods like the 2000 to 2002 dot-com collapse, the 2008 to 2009 financial crisis, and other market disruptions. The long-term average is real, but it is an average across years that included both substantial gains and severe losses. Understanding that volatility is the price of admission for the long-term return stocks provide is essential for staying invested through difficult periods rather than selling at the worst possible time. Stocks can be categorized along several dimensions that affect their return and risk profiles. Large-cap stocks are shares of large, established companies with market capitalizations typically above $10 billion. They tend to be more stable and liquid than smaller companies and often pay dividends. Small-cap stocks are shares of smaller companies with higher growth potential, but also higher volatility and higher risk of business failure. Growth stocks are companies expected to grow revenues and earnings rapidly, often trading at high valuations relative to current earnings. Value stocks are companies trading at lower valuations relative to their fundamentals, often because they are in mature or cyclical industries. International stocks, including both developed market stocks from countries like the United Kingdom, Germany, and Japan, and emerging market stock from countries with faster-growing but less stable economies, provide exposure to economic growth outside the United States. A well-diversified stock portfolio typically includes exposure across several of these categories, rather than concentrating entirely in one. Bonds are debt instruments. When you purchase a bond, you're lending money to the issuer, which can be a government, a municipality, or a corporation, in exchange for periodic interest payments and the return of your principal at the bond's maturity date. The interest payment on a bond is called the coupon, and it is typically fixed at issuance. The yield of a bond reflects the annual return relative to the current price. Bond prices and interest rates move in opposite directions. When interest rates rise, existing bond prices fall because newly issued bonds offer higher rates, making older bonds with lower rates less attractive. When interest rates fall, existing bond prices rise for the opposite reason. This inverse relationship is a fundamental characteristic of bonds that affects how they behave in a portfolio. The primary categories of bonds include United States Treasury bonds, issued by the federal government and considered the safest bonds available because they are backed by the full faith and credit of the United States government. Municipal bonds, issued by state and local governments, whose interest payments are typically exempt from federal income tax, and often from state income taxes as well, making them particularly attractive to investors in high tax brackets. Corporate bonds, issued by companies, which offer higher yields than government bonds to compensate for the higher credit risk of lending to a private company. High-yield bonds, sometimes called junk bonds, issued by companies with lower credit ratings, which offer the highest yields in the bond market but carry meaningfully higher default risk. The role bonds typically play in a portfolio is to provide stability, income, and a counterbalance to stock volatility. During equity market downturns, investors often move money into bonds, which can cause bond prices to rise at the same time stock prices are falling. This negative correlation, which is not perfectly consistent but is a historical tendency, means that a portfolio containing both stocks and bonds typically experiences less severe drawdowns during market stress than a portfolio concentrated entirely in stocks. The trade-off is that bonds also have lower long-term returns than stocks, so a portfolio heavily weighted toward bonds sacrifices growth in exchange for stability. Real estate is the third major asset class and the one with the most varied forms of access. Direct ownership of real estate, meaning purchasing a property, provides returns through rental income and property value appreciation. Real estate has historically served as a reasonable inflation hedge because property values and rents tend to increase with inflation over time. The limitations of direct real estate investment include its illiquidity, meaning you cannot sell a portion of a property quickly the way you can sell shares of stock, its high transaction costs, its management requirements, and the large capital needed to purchase even a single property. Real estate investment trusts, commonly called REITs, provide an accessible alternative to direct property ownership. A REIT is a company that owns and operates income-producing real estate and is required by law to distribute at least 90% of its taxable income to shareholders as dividends. REITs are traded on stock exchanges like ordinary stocks, which makes them liquid, accessible with small amounts of capital, and easy to include in a diversified portfolio. They provide exposure to real estate returns without the operational responsibilities and capital requirements of direct ownership. Cash equivalents are the most conservative asset class. They include money market funds, certificates of deposit, treasury bills, and short-term savings accounts. Cash equivalents offer very low risk to principal and high liquidity, meaning they can be converted to cash quickly without meaningful loss of value. Their return is the lowest of the major asset classes and in low-rate environments may not keep pace with inflation. Cash equivalents serve a role in a portfolio primarily as a reserve for near-term spending needs and as a buffer that allows an investor to avoid selling stocks or bonds during a downturn to meet cash flow requirements. Diversification is the practice of spreading investments across multiple asset classes, geographies, sectors, and individual securities to reduce the impact of any single investment's poor performance on the overall portfolio. The mathematical basis for diversification is correlation. When two assets are perfectly positively correlated, they move up and down together, and holding both provides no risk reduction. When two assets are negatively correlated, they tend to move in opposite directions, and holding both reduces the volatility of the combined portfolio without proportionally reducing the expected return. Most real-world asset classes and securities fall somewhere between perfect positive correlation and perfect negative correlation, which means that combining them in a portfolio produces a risk reduction effect that is proportional to the degree of their imperfect correlation. The practical implication of diversification is that a portfolio of many investments in different categories experiences smaller and less frequent extreme outcomes than any individual investment within it. A single company's stock can go to zero. A diversified portfolio of hundreds of companies cannot, because it would require every one of those companies to fail simultaneously. A single sector can collapse while the broader market holds up. A single country's economy can enter recession while global markets remain stable. Diversification does not eliminate risk, And in severe global market downturns, it does not prevent losses. What it does is reduce the specific risks associated with concentration in any single investment, sector, or geography. The concept of asset allocation refers to the proportion of a portfolio dedicated to each asset class. A common simplified framework is the idea of a stock and bond allocation determined by time horizon and risk tolerance. An investor with a 30-year time horizon might hold 90% stocks and 10% bonds, accepting high short-term volatility in exchange for maximum long-term growth potential. An investor approaching retirement might shift towards 60% stocks and 40% bonds, reducing volatility to protect accumulated wealth. These are simplified illustrations, not universal prescriptions, but they reflect the general principle that longer time horizons support higher equity allocations and shorter time horizons call for more conservative ones. Rebalancing is the process of periodically adjusting your portfolio back to its target allocation as market movements cause the actual allocation to drift. If stocks significantly outperform bonds over a period, the stock portion of your portfolio will grow to represent a larger percentage than intended, increasing your risk exposure beyond your target. Rebalancing means selling some of the outperforming asset and buying more of the underperforming asset to restore the original allocation. This process systematically enforces a buy low, sell high discipline and prevents the natural tendency of portfolios to drift toward increasingly concentrated positions in whatever has performed well recently. The foundational insight of this video is that diversification across asset classes is not simply a conservative strategy for risk-averse investors. It is the rational approach to portfolio construction for anyone whose goal is to build wealth reliably over time rather than to maximize the outcome of a specific bet. Concentration can produce spectacular results when the concentrated position performs well. It can also produce catastrophic results when it does not. Diversification trades the possibility of spectacular outcomes for the probability of reliable ones. And for most investors building toward long-term financial goals, reliable is worth significantly more than spectacular.